Hello everyone. I hope all of you have been preparing really well for your exams. As you all know, ICAI has come up with 8 model test papers for income tax intermediate level. I thought why not let's sit and solve MCQ part together. Now we know very well, as far as income tax is concerned, there are two parts of the question paper. One part handles the MCQs and the other handles the descriptive. So today we are going to take only the MCQs and solve together. Let's start with the first one right away. This is the first paper and I'm straight away heading to Division A MCQ questions. Let's take up the first one here. Mr. Kamal, aged 45 years, commenced operations of the business of a new 3-star hotel in Delhi. Okay, so as soon as we understand a hotel is coming, which means it may have something to do with 35 AD, specified business. Let's keep that in mind. It started on 1/4/2025. He incurred capital expense of rupees 50 lakhs on land. Now this becomes very important. Usually we would just read 50 lakhs and forget it. But here on land is more important. In March 2025, exclusively for the above business and capitalized the same in his books of accounts as on 1st April 2025. To claim 35 AD, this is one of a precondition that it should be capitalized on the first day. They have done that. Further, during the previous year 25-26, he incurred capital expenditure of 2 crores, out of which 50 lakh was for the acquisition of land and the remaining is for building, which means 1.5 is for building. It is exclusively for the above business. The payments in respect of the above expenditure were made by account pay check. Another condition satisfied. The profits from the business of running this hotel before claiming deduction under 35 AD, the specified business deduction before that for AY 26-27 is 85 lakhs. He has employed 220 new employees during the previous year 25-26 and the details of whom are as follows. So please note 220 new employees have come in picture. We have a category of number of employees, date of employment, regular, casual, total monthly emoluments per employee is also mentioned. All regular employees participate in recognized provident fund and their emoluments are paid by account pay check. Okay, his gross revenue from the hotel is 11 crores. It's crossed 10 crores. So which means tax audit automatically becomes mandatory. This is the highlight of the point here. Mr. Kamal has opted out of the default tax regime. Mr. Kamal also has another existing business of running a 4-star hotel in Ahmedabad, which commenced operations 20 years back. Profits from which are 140 lakhs for the AY 26-27. Assuming Mr. Kamal has fulfilled all the conditions specified for claim of deduction under 35 AD and has not claimed any deduction under Chapter 6A under the heading C, deductions in respect of certain incomes. Based on the above facts of the case scenario given above, choose the most appropriate answer to the following questions. Okay, so basically there are going to be 2 deductions here from the look of question. One we are talking about 35 AD and another one would be 80 JJAA. Let's see what is required from us now. What would be the quantum of deduction under 35 AD which he is eligible to claim as deduction for AY 26-27? Alright, so now we know there are 2 expenses which are happening here. In the previous year, 50 lakhs has been spent on land. So this is before 1/4/2025. We have 50 lakhs, but that's on land. And during the year 25-26, totally 2 crores have been spent, out of which 50 lakhs is again on land and 150 lakhs is on building. As far as 3580 is concerned, we know very well deduction is not available for the land part, only for the building, which means it would be 1.5 crore is for the building. Let's see if we have that in our options here. 250, 200, 100. Yes, 150D. It is there. So the answer is 1D. Let's take up the second one now. What would be the income chargeable or the loss under the head Profits and Gains of Business or Profession for AY 26-27 in the hands of Mr. Kamal? Okay, so we want to know only the PGBP. Let's understand what do we have right now. We have profits of the two hotels and we have 3580 reduction. If the deduction comes for 80JJAA, it would be a part of deductions under Chapter 6A and not here. So as far as PGBP is concerned, we would need profits of the business and 3580 deduction. So the profit here is 85 lakhs. So Delhi Hotel has a profit of 85 lakhs. Profit of Delhi Hotel is 85 lakhs. From here I am giving 3580 deduction, which is equal to 150 lakhs. So now we have this which will result in a loss. Now can I set off this loss with any other income? Yes, we can use other specified businesses. There is no such condition to set off. They should have also followed the rules and started only after a time period. So even if the Ahmedabad Hotel is 20 years back opened, even then we are eligible to use this loss here. So I am having a profit of 140 lakhs. So this hotel of Ahmedabad, it's a 4-star hotel. The criteria of the hotel is 2-star and above. It's fulfilling that criteria and the profit is 140 lakhs. So I have a profit of 140 lakhs. So let's just quickly calculate and see what do we get in the resulting figure here. This is minus of 65 lakhs. But when I use it with a profit of 140, I get 75 lakhs of profit. You know, the best part about MCQ question is, no matter how wrongly you calculate, your option will be there in A, B, C and D. And we feel so happy that, we've got it right. How come our marks are low? Maybe we have got one of the 4 answers, but not the right answer. So please look into these tiny little details. Had you not read the word 50 lakhs on land and then calculated, still your answer would be in these 4. I can bet on that. So we have our 75 lakhs here as option A. So we'll keep it as 2A. Let's quickly move on to the third one now. Would Mr. Kamal be eligible for deduction under section 80JJAA in AY 26-27? If so, what is the quantum? Before we get into the calculation of deduction, let's quickly recap what is 80JJAA even talk about. It is about additional employment. So it is giving a deduction of 30% of additional employee cost. What is additional employee cost? The new employees in the organization, additional employees into their emoluments. Okay? Into their emoluments. This is what is your additional employee cost. Now let's understand who are the new employees here. We have different conditions. Condition number 1. They should participate in recognized provident fund. We know very well the casual ones do not, which means this 50 and 20 do not categorize themselves as additional employees. It is only the others. Any employee whose contribution is completely met by the central government towards the pension scheme are not eligible here. Nothing is mentioned about it, so we ignore that condition here. Another condition, any employee whose monthly emoluments exceed 25,000 would also not be referred to as. So exceeding 25,000 per month is only this. We've already excluded them from the new employee category. The number of days criteria is 150 if they are in 3 industries: footwear, apparel and leather. But here it would be 240 because they are not in those industries. So we are talking about 1617. So if it is 16, they would have not worked for April and May. Around 304 days they are still working. And if they have not worked for June, it would be 274. Again, fulfilling the criteria here. Who have joined on 1/9/2025. September, October, November, December, Jan, Feb and March comes to 212 days, which means they do not qualify here. So even these employees are not qualifying. We only are left with the first and the second category, which means now we are good enough to calculate the additional employee cost. Please remember, deduction is 30% of additional employee cost. So I'll take it as 30% of additional employee cost. The additional employee cost for 40 employees is 24,000 rupees per month. And how many months have they worked? Don't do it 12 here. You will be wrong, but the answer will be in A, B, C or D. Okay? So here they have joined from the month of June, which means they have worked for 10 months. So this is first category, and second category would be 80 employees into 24,500 into 9 months. I'm not trying to solve in the specified format or a descriptive manner here because they are MCQs. Even you are not expected to solve it in a very elaborate manner. We only require the right option. So this becomes 96 lakhs. 30% of 96 lakhs plus 1.76 crores. So the answer here is 81,72,000. Let's quickly see if we have that in our option. Yes, we have 8172. However, I would like to give a small disclaimer here. ICAI material suggests here a different option. They are mentioning A according to them. But I have a very difference of opinion. I don't see how it would be A. If you know how it can be A, do let us know. Do reply to us and let us know how it is A. Until then, we'll keep our answer as C and move ahead. So that is with regard to the first question. Let's move on to the second one. Mr. Arvind, an Indian citizen, wants to file his return of income for previous year 25-26. Point to be noted, he is an Indian citizen here. He requires assistance for which he approached you. He has shared the following details relevant to previous year 25-26. Mr. Arvind owned a house property in Bangalore and the same was rented out for 75,000 per month to Mr. Arjun, a salaried employee. So Arjun is a salaried employee. He claims that this was the only income which he earned during previous year 25-26. However, when you sought for his bank statement, you observed following information additionally. There is a credit of 23,975 towards income tax refund, which includes 5,775 towards interest on income tax refund. We know very well only the interest portion is taxed as income, not the entire refund. On 15th August 25, bank statement shows a credit of 55,000 which he has claimed to have received as a gift from his grandchildren on his 60th birthday. Gift from grandchildren, whether it will be an income, taxable income, no, because it is coming from a relative. Grandchild becomes the lineal descendant and therefore finds a place in the definition of relative under 56(2)(10). On further assessment, you were able to understand that Mr. Arvind and his wife had travelled to Mauritius during previous year 25-26 to spend some time with their son who is staying in Mauritius. On scrutiny of their passport and relevant documents, you concluded they had left India on 27 September and returned on 31st March. During the 4 years preceding 25-26, both had stayed in India for 320 days only, which means the second condition of 60 plus 365 of last 4 days will not be fulfilled here. Okay. Prior to that, they had been staying only in India. Based on the facts of the case scenario given above, choose the most appropriate answer to the following questions. What is the residential status of Mr. Arvind for previous year 25-26? Is he ROR, RNOR, NR or deemed resident but not ordinarily resident? Okay, let's understand this. For how many days is he in India first? He is leaving on 27th September. We know for a person to be a resident, there are two conditions which needs to be fulfilled. First is 182 days in the previous year should be the period of stay minimum. And the second one would be at least 60 in the previous year and 365 in the 4 preceding previous years. Okay, he's an Indian citizen, so be careful with regard to certain criteria also. Let's see first what we get here. April, he's in India, May, June, July, August, September, he's only for 27 days. And he comes back on March 31st, which means he is on 31st March in India. 1 day that would be. So when we total up this, we get 181 days, which means the criteria is not fulfilled. We also know that he is not staying for more than 365 days in 4 preceding previous years. None of the basic conditions are getting fulfilled and therefore we can safely assume he is a non-resident. Once he is a non-resident, further criteria is automatically not getting fulfilled. So answer would be 1C. Is there any requirement to deduct tax at source under section 194IB on such rent by Mr. Arjun? If yes, what would be the amount of TDS to be deducted? Okay. Now what is happening? Who is Arjun? Remember, Arjun is our salaried employee to whom Arvind have given a house on rent of rupees 75,000 per month. Will TDS come? Yes, TDS will come. We know very well when there is a rent exceeding rupees 50,000 per month, and if anyone who is not deducting under PGBP requires to deduct under 194IB. We already know this precondition, but we also know very well that this condition is only for resident, deducting it for resident, which means if we just look into our answer of 194IB, we may find the 2% criteria when we calculate, but we will be wrong. Why? Because right now, Mr. Arvind is not a resident. He becomes a non-resident. Once they become a non-resident, these conditions don't apply to them. 195 starts applying to them, which means as far as 194IB is concerned, there is no requirement to deduct tax at source. So now we are left with two options. It is not B, it is not C. What is A? No, there is no requirement to deduct tax at source under section 194IB since Mr. Arjun is a salaried employee. No, there is no condition. We are not deducting tax at source, not because Arjun is a salaried employee. For salaried employees, 194IB is correct one. So I don't think so. This is also the answer. No, there is no requirement to deduct tax at source Under section 194 IB, since Mr. Arvind is a non-resident. Yes, because he is a non-resident, the provision moves to a different section. So the answer is 2B. Let's take up the third one. Which of the following statements is correct with respect to advance tax liability of Mr. Arvind for previous year 25-26? Advance tax liability shall not arise to Mr. Arvind since he is a non-resident. Okay. We know very well when does advance tax liability arise, when the tax amount to be payable exceeds rupees 10,000. There is no such condition that it should happen only in the case of a resident or a non-resident. So just because he is a non-resident, there is no condition that advance tax liability will not apply to him. Advance tax liability shall not arise since Arvind is a resident senior citizen. Arvind is not a resident senior citizen, he is a non-resident actually, and he has no income chargeable under PGBP. No, not correct. Advance tax liability shall arise since he is a non-resident. Just because he is a non-resident, will we have advance tax liability? No. Income criteria is seen here. Advance tax liability shall arise since his tax liability is not less than Advance tax liability shall arise since his tax liability is not less than 10,000, which means his advance tax liability is more than 10,000. Yes, because of this. So 3D becomes our answer here. So that's how we solve. Please take a minute more if you're not able to understand the question here, because you know very well each of them carries 2 marks. Very easy to score, very easy to lose. We are very much on the edge here. Let's take up the third one. Rashmi Limited has 2 units. One unit at SEZ and the other unit at DTA. The unit in SEZ was set up and started manufacturing from 12/5/2016 and the unit in DTA from 15/6/2019. By now, we know very well what are we going to talk about. We're talking about somewhere deduction of 10AA. Let's confirm that. Yes, we're talking about deduction under 10AA, which is export profits. Deduction for export profits. As far as export profits are concerned, we only look into the SEZ export profits and not the DTA. So any information about DTA here is irrelevant. We do not bother when they are even starting up. Total turnover of Rashmi Limited and DTA is 12,50,000 and 450. Irrelevant. We need SEZ, which is not here, but we can calculate. Export sales of unit in SEZ and DTA is 350 and 225. Relevant only the SEZ portion. Respectively, our net profit of the unit of SEZ and DTA is 95 lakhs and 80 lakhs respectively. Out of the export sales of 3 crore 50 lakhs, 2 crores have been received in convertible foreign exchange by Rashmi Limited, by 39/2026. Export sales would be taken into account only to the extent they have been received within 6 months from the end of the relevant year in convertible foreign exchange. So that amount restricts itself to 2 crores. Rashmi Limited would be eligible for deduction under 10AA for which of the following? Now there are too many things here. Let's start from the first one. The unit is starting to manufacture itself in 12/5/2016. As far as 10AA is concerned, they are eligible, any SEZ unit is eligible for a deduction for 15 ABIs. For the first 5 years, 100% of export profits. For the second 5 years, which is 6th year to 10th year, 50% of export profits. For the 11th year to 15th year, it is 50% of export profits or amount allocated to SEZ reinvestment reserve account. I hope you are able to recall the provision. Here, whichever is lower would be taken into account. The manufacturing date is 12/5/2016. which means on 12/5/2025, 10 years would happen. This is the 10th year. Yes, if 16, 17 was the first year, this would be the 10th year, which again happens to be our year, which means as far as we are concerned, this is the 10th year. So 50% of export profits would be the reduction. So first conclusion we have come here. What is export profit? We know very well export profit is equal to net profit of SEZ divided by total turnover of SEZ multiplied by export turnover of SEZ. Do we have the net profit of SEZ? Yes, net profit is given to us of SEZ and DTA is 95 and 80 lakhs respectively. So it is 95 lakhs. Do we have the export turnover? Yes. Only 2 crores have been received in convertible foreign exchange. So even if there is more of export sales, we will ignore it. We will only take 2 crores here. Divided by total turnover. Do we have total turnover? We have it of Rashmi Limited and DTA. So if Rashmi Limited has only 2 units, SEZ plus DTA, which means the difference here would be for SEZ. So SEZ turnover would be 12.5 crores minus 4.5 crores, which is 8 crores. So this is our export turnover. We know very well deduction of 10AA would be only 50% of above. Don't forget that. So our answer is 95 lakhs. When multiplied with all of this would be rupees 11,87,500. So let's see if we have that in our option. Option C, 11,87,500. That's our answer. Let's take up the next one, which is the last MCQ for the first MTP here. Fourth one. What would be the tax liability of Miss Savita, a resident who attained the age of 60 years on 1/4/2026? Our year is 25-26. This is the next year's date. On the total income of 7,25,000, comprising of salary income and interest on FD under default tax regime. Okay, this changes the entire question. Had it been optional tax regime, this age criteria would have been very much relevant for us because we would be applying a threshold of 3 lakhs and not 250. But because we are under default tax regime, we are not bothered about the age criteria at all. So her income is 7,25,000. She is also a resident. Technically, you would start solving up to 4 lakhs, 4 to 8, 8 and above, all of that will start here. But please remember, we have something called as 87A rebate, which says if a resident's income is less than 12 lakhs, they are eligible for a rebate. Is her income below that? Yes, and she has no special income. It is only the basic income. So we are safe enough to assume the tax would be nil in this case. Yes, it's under default tax regime. The rebate limit is now 12 lakhs as far as the new budget is concerned, and therefore it would be nil. So this is as far as the first MTP questions are concerned, MCQ part. I'm not getting into the descriptive part that is already solved in the MTPs for you. If you have any doubt, you can definitely come back again. Let's move on to the second one now. Let's take up the second MTP here. Please have a habit of at least doing rough calculations whenever you're solving in the exam, because no matter how much you mentally calculate and load those informations cannot be retained. Yes, so have a habit of roughly calculating whatever is required for you to calculate. And whenever you're reading, if you feel there is something you need to remember it later, even that could be jotted down. Obviously not on your question paper, on your calculation sheet. Let's start with the first question of second MTP. Mr. Pankaj, an Indian resident, purchased a residential house property at Kanpur. Okay, so he's buying a residential house property at Kanpur on 28/1998 for 20.5 lakhs. 1998, which means our base year is being crossed, 1/4/2001. It is much earlier than that. Fair market value and stamp duty value of such property as on 1/4/2001 is 28.5 lakh and 25 lakh respectively. Okay. So we know very well if it is purchased before 1/4/2001, assessee gets a choice as far as cost of acquisition is concerned. He can take his original cost, which is 20.5, or he can take the fair market value, which is 28.5, but it cannot exceed the stamp duty value of 25. Subject to all of these permutation and combination, 25 lakh will be the maximum value you can take for cost. Let's continue and understand what else is given to us. On 5/2/2016, Mr. Pankaj entered into an agreement with Mr. Gyan for the sale of such property for 61 lakhs and received 2.5 lakhs as advance. However, Mr. Gyan did not pay the balance amount and Mr. Pankaj forfeited the advance. Okay, we have a date here also, 5/2/2016. We know very well if the advance is forfeited before 1/4/2014, it requires deduction from the cost. Since it is after that, it would have been treated as income from other sources in the relevant year itself. As far as 25-26 previous year is concerned, we can safely ignore this information and continue further. On 10/5/2025, Mr. Pankaj sold the house property to Mr. Rohan for 150 crores. Stamp duty value of the property is 2 crores. Further, he purchased 2 residential house properties at Delhi and Mumbai for 57 lakhs each on 28/9/2026. Mr. Pankaj has no other income during the previous year 25-26 and the due date for filing return of income for Mr. Pankaj is 31st July 2026. Okay, we have an issue here. We'll discuss it later if the question so arises. On 31/1/2027, Mr. Pankaj decided to sell the house property at Mumbai to his brother, Mr. Gaurav, for 58 lakhs, from whom 25,000 was received in cash on 15/1/27 as advance for signing the agreement to sale. Sale deed was registered on 13/3/2007 on receipt of balance amount through account pay check. Please remember, this is received in cash. So for us, this date becomes more relevant. The registration date becomes more relevant. Stamp duty value of house property at Mumbai on 31/1/2007 and 33/2027 was 61 lakhs and 64 lakhs respectively. We will ignore 61 lakhs and take 64 lakhs. Why? Because it is received in cash, the advance. So we have ignored the agreement is even existing as on that particular date. It is only the registration. Cost inflation index of different years have been given to us. Okay. Based on the facts of the case scenario given above, choose the most appropriate answer to the following questions. What shall be the cost of acquisition of residential house property at Kanpur? Okay, for computation of capital gains in the hands of Mr. Pankaj. So we need to find out the cost of acquisition. We already know the property is purchased before 1/4/2001, which means the assessee would be given a choice. What is this choice? Either take 20 lakhs, 20.5 lakhs, or take 28 and 25, whichever is lower. So it is going to be cost of 20.5 lakhs versus stamp duty value of 25 lakhs, whichever is beneficial for him. Obviously it is 25 lakhs. So our answer would be 1C. 25 lakhs of stamp duty value will be the cost of acquisition here. Let's take up the second one. The amount of capital gains taxable for AY 26-27 in the hands of Mr. Pankaj for sale of residential house property at Kanpur is what? Okay. Now here, we need to calculate the capital gains. What is capital gains? Full value of consideration minus cost of acquisition will give us net consideration. From that, any exemption under 54 series will come and will give us the capital gains. Okay, roughly speaking, it would be so. We already know our cost of acquisition is 25 lakhs. Let's keep rupees in lakhs here. Let's take up the full value of consideration now. The property is sold for 1 crore 50 lakhs and the stamp duty value is 2 crores. We have a section 50C which will be applicable here. Okay, now what does 50C say? 50C says that in case you are having your stamp duty value higher than your selling value, in that case, stamp duty value will be taken as the full value of consideration, subject to it being higher than the difference of 10%. In simple terms, I will take two amounts here. Let's come back to our original calculation. 150 lakhs and 2 crores. Okay, or 200 lakhs. Even if I increase this by 10%, it would be 165 lakhs, which is still short by 200 lakhs, which means our full value of consideration would be under 50C, which is 200 lakhs. So if I subtract this, it is 175. What is being sold? Residential house property. Has he acquired any other residential house property? Yes. In fact, he has acquired two, which means there is a possibility he can claim 54 exemption. Now, what does it talk about? He has taken two properties of 57 lakhs each on 28/9/2026. But his due date of filing of return is 31st July 2026. So when he is filing his return, he requires a proof of investment in the new property. Either he should have invested the money in a capital gain account scheme, or these investments should have happened before that. Since the date is already crossed and no capital gain account scheme is even mentioned in the question, we can't assume anything here, which means there is no exemption that can be given under 54. So the capital gains is still 175 lakhs only. We do have this one as the answer here. So it is 2C. Yes? Let's take up the next one. The amount of capital gains taxable for AY 27-28 in the hands of Mr. Pankaj for sale of residential house property at Mumbai. Okay? So now we are talking about the property of Mumbai, not the Kanpur. Let's come back and see what details do we have here. Mumbai property was sold to his brother for 58 lakhs. Okay. So the actual sales consideration is 58 lakhs, but the stamp duty value is 64 lakhs. He's purchased it for 57 lakhs each. So his cost of acquisition is pretty much clear to us. It is 57 lakhs. Now, if I increase this with 110%, I'm still falling short by, it comes to 63.8, which means I'm still not reaching 64 lakhs. So, I will have to take the full value of consideration as 64 lakhs only, minus cost of acquisition, which is 57 lakhs. Therefore, the capital gains would be 64 minus 57, 7 lakhs. So it is 3B, which our answer will be. Yes? Please note, in these MCQs, if your earlier understanding of 2, subsection 2 was wrong or subquestion 2 was wrong, it would have a domino effect in all the answers. Which means if the first one is wrong, you've got a wrong cost of acquisition, your capital gains is wrong. If you've got a wrong capital gains, everything else which would follow will again be wrong. So take some time to gain conceptual clarity here. That will only help. Fourth one, the amount taxable under 56.210. Okay, we have gone to 56.210, which is nothing but, we call it as gift under income from other sources. In the case of Mr. Gaurav. Now, Pankaj has sold to Gaurav. Gaurav happens to be his brother, if you are right. Remember even that part? Yes. His brother. Okay, so remember all of this. Well, under 56.210, if there is an inadequate consideration of an immovable property which exceeds 50,000 or higher of 50,000 or 10% of the consideration, it would be taken as a taxable income in the hands of the recipient. However, we know very well as far as relatives are concerned, gifts are not taxable for them. So this inadequate consideration is not going to be taxable in the hands of Gaurav. Why? Because he's a relative brother. So our answer is nil. It would be 4A. Okay? What shall be the tax credit available with Mr. Pankaj with respect to sale of property at Kanpur during previous year 25-26, assuming the tax was fully deducted by Rohan? Okay, so we are talking about 194IA here, where the seller will have to deduct tax at the rate of 1% on what? On sales consideration or stamp duty value, whichever is higher. We know in this case it was the stamp duty value which was higher, 150 and 2 crores. So on 2 crores, if it is 1%, it would be 2 lakhs. Yes, we do have the answer as 2 lakhs, 5A. The last one for the first question. Is Mr. Pankaj required to file his return of income for AY 26-27? If these statements come, please take up statement one by one, analyze, eliminate. Okay? We'll do that now. Yes, since his total income exceeds the basic exemption limit. Yes, it makes sense. So for now, this is making sense to me. I'm going to keep this on hold. No, his total income does not exceed the basic exemption limit. Well, we saw the capital gain itself being 175 lakhs. So this is not going to make any relevance here. Yes, since tax deducted in this case exceeds 25,000, but we have a more appropriate answer. Yes, since his total income before exemption under 54 exceeds basic exemption limit. Well, we are not claiming any exemption in this particular case. So it is going to be 6A. Always choose the most relevant answer or reply to this particular case. Don't take a general one. So it is 6A. Let's take up the second one now. Mrs. Deepika, wife of Mr. Santosh, started a business of trading in beauty products on 15/7/2025. Okay. She invested 5 lakhs in the business on the same date out of gifts received from her husband, Mr. Santosh. She invested 4 lakhs from her own savings on the same date. She earned profit of 9 lakhs. Investment 9 lakhs. Profit is also 9 lakhs. Be careful here. From her business for the financial year 25-26. Which of the following statements is correct? I'll read the statements also. Share of profit of 9 lakhs is includable in the hands of Mrs. Deepika. 5 in the hands of Santosh. 4 in the hands of Deepika. 4 in the hands of Santosh and 5 in the hands of Deepika, or 9 in the hands of Mr. Santosh. So we have these options here. Okay. Let's understand what is it talking about. So we are taking up a concept of clubbing here, where investment or the income of the spouse comes in picture because of investment made in the business. Usually, we check the capital as on the first day of the year. But there was no business on the first day of the year. The business itself started on 15th July, which means whatever profit is being made is from this date to 31/3/2026. Now we have two people, Santosh, Deepika. Santosh invested 5 lakh, rather gifted 5 lakh, and Deepika further invested. And this is 4. Right? 4 from her own savings, 5 from husband's gift. Total comes up to 9. Profit of the business is also 9 lakhs. The question is taxable for whom? In this case, I would not see the capital on the first date. Why? Because the business itself is not existing on the first date. We would see it from the first date of the business. So, yes, clubbing will be applicable in the very same ratio of 5:4, which means 5 lakhs will be taxable in the hands of Mr. Santosh and 4 in the hands of Mrs. Deepika. Our answer would be 2B. Let's take up the last one here, which is for 1 mark. Mr. X, a resident, 47 years, has salary income computed of 7,25,000, agricultural income of 1 lakh. Okay. Compute his tax liability if he has opted out. Okay. Opted out of the default tax regime. Had he been in default tax regime, our answer would have been very simple. Give him a rebate and move ahead. But he is in optional tax regime, which means now we have to start with the age. 47, resident. Okay. So we are having 2 incomes. One is a regular income of 7,25,000. Another one is an agricultural income. Integration, partial integration will be applicable. So we are talking about the regular income of 7,25,000 and agricultural income of 1 lakh. Total income of 8,25,000. Yes, this is his total income. If I tax the entire thing, 8,25,000 up to 2,50,000 would be exempt. Up to 5 lakh it is 12,500, and on the balance it is 20%, which means 3,25,000 into 20% is 65,000. So this is totaling up to 77,500. Let's call this as step 1. Step 2 is where you will give them the relief. I would take the agricultural income here, 1 lakh. Take the basic exemption, total it up, and now calculate the tax on this. The tax on this we know is up to 250 NIN, and on the balance, that is on 1 lakh, we would have 5%, which is 5,000, totals up to again 5,000. So the relief which we are giving here is 77,500 minus 5,000. Final tax after integration would be 72,500. Let's add health and education cess here of 4% here. 2,900. Totals up to 75,400. Yes, our answer is 75,400, which is option C. Okay, so third answer becomes option C. So this was the last MCQ of MTP 2. Okay, so with this we have completed 2 MTPs. Let's continue the others. later in the second part. Before I wrap up the session, please remember MCQs give you marks very easily. It can help you score and it can help you lose marks also. Your conceptual clarity would be playing a very important role here. Please work on your conceptual clarity and remember to read the entire question before you start attempting. That's it for today. Thank you so much.